Hi, everybody, and welcome to the Marshall Hangout. This week, we have an illustrious panel to speak to us about COVID-19 and economic policy. Really excited. Thank you for Rahul for pulling this panel together. This is the first Hangout we're actually running in conjunction with the Association of Marshall Scholars as well, which is fantastic. This is a series of Hangouts that we've been doing over the past 18 months. So if you're interested in seeing others, they're all on the Marshall website, and I'm happy to share the link later if you would like to see them. So thank you for coming today. We have, I think, a really interesting panel. We will start with the panel discussion, and then when we get to the Q&A section, if you'd like to ask a question, I ask you to type your name into the comments, into the chat, and then we will call upon you, or Rahul or I'll call upon you to unmute and ask your question, which in that way means that you get more of a conversation than if everybody types their questions into the chat. So thank you very much, and I will hand over to Rahul.
Thanks, Mary. Thanks everyone for being here. We're really excited about this panel. We think it's going to be a really compelling discussion. The premise, well, let me take a moment, I guess, introduce myself. So Rahul Rekhi, I'm a 2013 Marshall Scholar, currently with Lazard Investment Bank, and I'm the vice president there. And I also run a group called the Next Bretton Woods Group with the Peterson Institute for International Economics. The premise for this panel, as you saw on our event invite, is to bring together a group of folks who have a range of experiences and perspectives across academic economics and economic research, public policy, economic policy, and then the capital markets. And to do that, to convene a pretty rich discussion around a central set of questions that revolve around what is it that we've learned from the economic trajectory of the past year in the wake of the COVID shock, as it were. The pandemic has led to a topsy-turvy year in many respects, and in many ways, the economics world is no exception, as the panelists will describe, and as we'll get into. Many of the kind of initial forecasts that a pretty wide range of forecasters predicted about the nature and scope of the trajectory of the pandemic from an economic perspective have been confounded, revised at various points, and it's challenging in some ways some basic questions among economic policymakers about, for instance, the nature of the relationship between workers and firms, the labor market writ large, and as some of you may have followed in the press very recently around the kind of nature of overheating of the economy and around inflation. It is also called into question and sort of raised interesting discussion topics around what are the appropriate toolkits, as it were, for economic policymakers. What does it mean for future recoveries when for instance, the Fed has created a series of new credit facilities and backstops in the wake of this pandemic to stabilize the capital markets? And did that work? Did it not? And should that be part of the standard toolkit going forward? So look, incredibly broad range of topics. We'll try to cover as many as we can in the hour. Let me take a moment to introduce the panelists, and then I'll sort of walk through the game plan for the event itself, and then I'll kind of hand it over to those folks to walk through some of their opening remarks. So first off, we have Lisa Cook. Lisa is a 1984 Marshall Scholar. She's a professor of economics at Michigan State University, and prior to that was with the Harvard Kennedy School. Dr. Cook's work as an economist, as a research economist, has spanned a range of areas, growth and development, consumer finance and financial institutions, and economic history. And she has also taken her academic background to Washington, D.C., where she served at the Council of Economic Advisors in the Obama White House between 2011 and 2012. And I should add, therefore, was front and center to the economic recovery efforts following the global financial crisis in 2008-09. She was also deeply engaged with the Biden-Harris transition effort, particularly on the kind of agency review team for the Federal Reserve and banking and securities regulation. Dr. Cook was a Marshall Scholar, as I mentioned, in 1984. She was the first from Spelman College to win that distinction, went on to study the PPE at Oxford, apologies, and then did her PhD in economics at Berkeley. Our next panelist is Jim Poterba. Jim is Mitsui Professor of Economics at MIT. He also, in his ample spare time, serves as president of the National Bureau of Economic Research, which is the foremost institution for overseeing, developing economic research in U.S. and indeed global economic institutions. Beyond his roles at MIT and the NBER, he has served in a variety of leadership roles in the sort of economics research community, including being president of the National Tax Association and the American Economic Association, among others. Dr. Poterba is one of the most foremost public finance researchers in the country. His work is focused on tax policy, retirement finance, and a number of other areas. He served in that capacity as a trustee for the TIAA CREF and a number of other funds, and indeed on the president's panel for tax reform under President Bush. He graduated from Harvard, did his DPhil in economics from Oxford on the Marshall Scholarship. And then last but certainly not least, Howard Newman. Howard is managing partner of Pine Brook, which he affirmed that he co-founded. Prior to coming to Pine Brook, he was with Warburg Pincus for 22 years as a vice chairman, as a senior advisor. And he's focused in particular on energy and financial services throughout his career, but particularly at Pine Brook. He's served on the boards of 45 companies, including a number of public companies. And like our other panelists, has been involved in the policy world as well, including serving as advisor on energy issues with former Governor Pataki of New York and the Long Island Power Authority. Like our other panelists as well, it should be Dr. Newman, not just Howard Newman. Dr. Newman has a PhD in business economics from Harvard, did his Marshall Scholarship at Cambridge, and then graduated from Yale in economics prior to that. So as you can see, very illustrious group, as Mary mentioned. And I have one correction, I suppose. Dr. Cook, apologies, class of 1986, not 1984. Sorry about that. But I'm looking forward to hearing all your remarks. The way the panel will be structured is we'll have each of these folks, starting with Dr. Cook, give a few remarks for a few minutes on the kind of overall premise of the question. What have we learned from an economic point of view and to inform policymaking in the wake of COVID-19? We'll then turn to Dr. Poterba, do the same, and then follow up with Dr. Newman. And then, I'll sort of take us through some Q&A to spark the discussion, and we'll leave plenty of time at the end for audience questions as well. So before I hand it over to Dr. Cook, I want to say one more thing, which is a general thank you to, in addition to Mary's leadership in pulling this together, also want to thank Nell Breyer from the Association of Marshall Scholars for co-sponsoring this event and for playing a key role in helping pull this together. The AMS, the Association of Marshall Scholars, has sort of taken on the remit of organizing events around the Marshall alumni community. I've personally benefited from their leadership in this regard, and hopefully all of you do as well. And they have this excellent newsletter that codifies events just like this. So with that out of the way, let me hand it over to Lisa for her opening remarks. Thank you, Lisa.
Thank you so much, Rahul and Mary, for this invitation and for putting together this great conversation. I just want to talk about a couple of things first to get us started. And those things relate to how we fundamentally think about the economy. Recently, flaws in the way we economists think about the economy's potential, especially potential output, have been highlighted. I agree with those who believe that we must rethink how we estimate the economy's capacity, especially as it relates to its capacity related to innovation. I would like to address structural change and structural factors related to output. In the pandemic and in the wake of George Floyd's death, this is the first time in my career as a macroeconomist that factors related to race have been taken seriously in discussions of and literature on the economy's capacity. I've had more conversations in the last year about constraint on the economy related to racial discrimination than in all of the 20 years of my career combined. I think this is critical to thinking about potential output and long-run growth going forward. Let me just summarize a couple of problems, three problems actually, associated with estimating potential output in the output gap. First, over time, revisions to the CBO's estimates, so the Congressional Budget Office's estimates of potential output, are asymmetric and have a distinct downward bias. Now, this is important because all other agencies within the federal government rely on the CBO's estimates. It is an independent agency, it is nonpartisan, and their estimates are the ones that we had to use, for example, at CEA. And this is something that is, it is structurally important for not just policymaking, but for everyone else, all other actors in the economy. So that potential output from 2005, from 2010, from 2015, all suggest that potential output was too high, that it was missed, that real GDP was much lower than those three estimates is troubling. Something is happening with the economy and with CBO's models, and we are going to talk about that more, but I'd like to lay out the fact that this is problematic. Now, I'd like to pivot to what one of the potential factors related to CBO's estimates of potential is, and that has to do with unemployment rates. The assumption in CBO models is that Black unemployment will be twice that of whites. And what I would suggest is that we should think about not what the potential has been in the past with respect to unemployment rates. We should recognize that there are systemic factors in these estimates of unemployment and in labor markets, and try to address those to increase potential. So let me lay this out a bit more specifically. Currently, the unemployment rate for Blacks is 9.7%, and for whites, it is 5.3%. And historically, it has been twice that. We've seen some closing during the last years in the last years, but this has historically been what has been assumed and has been the case. What I would suggest is that we should really tackle those issues. Why is that? Those issues related to the labor market, especially related to innovation. Unemployment with respect to the innovation economy mirrors that of the overall sector. So in 2019, the unemployment rate for scientists and engineers among African Americans was 4.7%, the highest among any group in the survey and the NSF data. For white scientists and engineers, it was 2.1%. So this is more than double that. So this is in 2019. This isn't in 2020. This is in 2019. For Asians, it was 3.3%. For Hispanics, it was 3.8%. And for all scientists and engineers, it was 2.6%. And for the general population, it was 3.7% in 2019. So a Black unemployment rate among scientists and engineers of 4.7% is not only higher than that for whites and all other ethnic groups, it's also higher than for the general population. The upshot is that we are missing out on potential output. We're not only underestimating the productive capacity of the United States, well, we're overestimating, CBO is overestimating, but we're not taking into account these systemic factors that could actually augment GDP. And I'll give you one of the calculations that my co-author Yan Yang and I did recently. And what we showed was that GDP per capita could be 0.6% to 4.4% higher if African Americans and women were incorporated into the innovation economy more systematically. That's a lot of potential that is being left on the table. So I don't want to miss what we're seeing with the overall economy and not take into account the structural factors. What if patent teams and other institutions started taking advantage of this potential? What I find in another paper is that co-ed patent teams are more productive than single-sex female or single-sex male teams. Again, that means that we're missing out on a lot of potential if we are allowing the free flow of ideas to be stifled by systemic factors like racism and sexism. So I hope that we'll think about these when we're thinking about the dynamism of the economy more generally. This is the context that I want to take into account when we're talking about other factors, other macroeconomic factors today. Thank you.
Thanks so much, Lisa, for your remarks. Jim, I'll hand it over to you.
Great, and Rahul, thank you so much for organizing this gathering and for inviting me to participate. What I would like to do, in part because I've become accustomed, I think, that Zoom and sharing a PowerPoint deck somehow go one in hand with each other. I'm going to step back from what Lisa just did and do a little overview on some of the kind of key facts about the COVID-19 economic shock. And I think that will set us up for the discussion of some of these issues about what the lessons are for economic policy as we look at this. Right? So one thing to just understand is the enormous magnitude of what happened last spring as we went from early March into mid-April. To put this into context, the largest prior changes in the US unemployment rate in any given month were about 1 percentage point. You had to go back to the early 1950s to find a change that large. In April, we saw a 10.3% increase in the unemployment rate. Right? So this is just historic proportions. It was taking us way outside the sample of anything we'd experienced before. And I think it partly helps to provide some context for a question Rahul asked, which is, well, how come we didn't get the forecasts more accurate as we were doing this? We hadn't quite seen anything like this, especially anything where the reason the unemployment rate went up was because the government was telling a whole swath of the economy you had to close. Right? So figuring out what the dynamics of that system are tricky based on historical experience, right? So that's the place to start. Okay. The second thing to recognize is that when you look to see the employment change in the economy, this is just showing you the total number of employees in the U.S. economy. Okay. The unemployment rate, of course, is related to that, but you see that going into the pandemic, we had about 152 million people working in the economy. By April, we were down to about 130 million, right? Remarkable. Okay. Well, then, of course, you see that we get half the way back within a few months after that, right? And that is part of the challenge, is understanding, who was in that V-shaped recovery and who was actually part of the group that is still experiencing a very long, drawn out, low level of economic activity. And the most important takeaway from the pandemic economy is heterogeneity across groups. Okay, and this will link up very much with what Lisa was saying a minute ago. Racial groups, wage level groups are all experiencing different kinds of pandemic experiences. And one of the major economic policy challenges has been trying to tailor policies that might be able to address the very different pandemic experiences of different groups and provide economic support for them. So let me just show you a little bit about the heterogeneity. I'll do this by different sectors of the economy and then by different kinds of workers, and then I'll stop. This is a chart taken from a very nice data portal at Harvard called the Opportunity Insights Tracker. And it shows you a measure of consumer spending in the US economy starting in January of 2020 and finishing at the end of last week. Okay. And what you can see is that in April and into early May, the US economy just fell off a cliff in terms of spending, right? Consumer spending was down nearly 30% at that point early in the pandemic. Today, consumer spending is actually 16% higher than it was at the beginning of the pandemic experience, right? And of course, that aggregate number covers many different moving parts. So let me just show you, how that looks if you look at, say, the restaurant sector, the entertainment and recreational sector, right? These are, of course, two of the sectors most hard hit, where recreation and entertainment was down close to 90% at one point in the early part of the pandemic, and has struggled to come back. So if you were a worker in that sector, this has been really a tough thing. If you're in the restaurant and hotel sector, right, they are now back to basically where they started in the pandemic economy, but after a harrowing decline of over 60% in the early months. And of course, their trajectory has been very much driven by policies at the state level in terms of allowing them to open or not, and by the pandemic response elements of this. Okay, but let's look at two other sectors where the experience has been quite different. This is looking at grocery and retail. Okay, those of you who, like me, were getting up early in the morning to go to the grocery stores back in late March and early April will understand that giant spike of 60% increase in groceries that we saw in the first few weeks of the pandemic. And groceries today are still about 20% higher than they were in January or February of 2020. And that probably reflects a shift from the restaurant sector is smaller, the in-home sector is larger, and that's part of what's going on. The other surprise to many people was the strength of the retail sector, right? Partly driven by online purchasing, but what you see in that green line is that retail today is about 28% higher than it was before the pandemic started. And one of the lessons here is, who knew that the vacation in Key West was a close substitute for buying a fire pit for the backyard, and that those were products in some sense which many consumers with the wherewithal to allocate discretionary income thought of as in some sense being trade-offs that they could experience. So what this suggests is that at some level, where you started the pandemic had a lot to do with how the pandemic played out. Right? My guess is many of us who are on this call were very fortunate in the sense that our jobs were jobs that could be done from home, that we were able to move rather seamlessly to a world of virtual work, and that in some ways the pandemic was a major dislocation to the economy, and but it was not something which was a livelihood threatening event in the way that it might have been if you were in the entertainment or the hospitality sector, particularly a low-wage worker in one of those sectors. Just to give you a sense of the nature of the wage level and the impact of all this, today we are employment is down by around 5% relative to where we were at the start of the pandemic. But echoing some of Lisa's numbers, low-wage workers are down by twice that amount. Right, so this is the group that has borne the brunt of this. The high-wage workers are at less than half of the decline for the economy at large. Change in employment, if you disaggregate by ethnic groups and by gender groups, Black women have seen the largest decline in employment, followed by Hispanic and Latino women. White men are down only about 5%, and that's close to the national average there. But other groups experiencing much more. This is by February, so the losses were larger. So more loss there. So what this kind of gives you a sense of is kind of the pain side of this. Let me close this little overview by just saying something about the policy response, because I think a key part of what we've learned is that policy can jump in important ways. And there have been two really important policy initiatives. One is the use of fiscal policy, and these are essentially the stimulus payments that have been made, which have been very broadly distributed to a part of the population, which includes both those who were immediately affected and those who were not as much affected, but to try to support the economy as we go. You can see that this is a historic period in terms of the US federal budget deficit, touching a 15% of GDP deficit during fiscal 2020 is a remarkable thing, and takes us to something we have not seen before in peacetime in the United States. But that spending in some sense helped to support the economy. And the IRS, which is a much reviled organization many times in discussions of policy, has actually, deserves enormous kudos for managing to step up and very quickly distribute stimulus payments starting last March and doing it again in many other circumstances as we've gone through the last 15 months. So the fiscal policy side is a key part of what happened. The other part is what's happened with monetary policy. And the Federal Reserve has basically reinvented its playbook to address what's been happening in the last 15 months. Cutting the federal funds rate, making interest rates very low, which helps to stimulate the economy on various margins, also helps to stimulate asset markets, and undoubtedly has contributed in significant parts to the run-up in asset prices, stock prices, house prices, used car prices, everything that one can spot that's a durable asset. The Fed has been purchasing bonds in the financial markets and supporting those markets very directly. It's a little hard to put this number into a context, but the Federal Reserve had a balance sheet of assets that it owned, which was about $4 trillion in January of 2020. Today, that number is twice as large. It's $8 trillion. So, the Fed's basically bought 20% of GDP during the course of the last year. Well, that's a pretty big thing, and a lot of stimulus that they've been injecting into the system. And they've done a number of other things which provide financial support for financial markets and institutions. I think one other thing we may come back to in the Q&A is they've also been talking during the last year about a revision to the monetary policy framework in the United States, which focuses on the idea that we will place greater emphasis on trying to be developing an inclusive economic recovery. Speaks to some of the comments that Lisa offered earlier, but that's something that the Fed is not just doing in the immediate term. It speaks to longer term issues and investor expectations about Fed policy. And I think that could be another important part of what has come out of this. So I'm going to stop there, and then we can come back in the Q&A and talk about some of the broader lessons learned for policy.
Thank you so much, Jim. That was terrific. Howard, I'll hand the mic to you, and then we'll get into the Q&A.
Thank you, Rahul and Mary, and to Lisa and Jim for their comments. So I actually approach this from a different perspective, which is from the standpoint of somebody who was on the front lines of seeing what happened when the COVID shutdown hit. For those of you who don't know, the business I run finances oil and gas companies, and it finances financial institutions, many of which are focused on serving the underbanked. And those of you who remember last March, remember that the oil and gas industry was hit not only with a cessation of demand, but we were also in the backwash of the Saudi-Russia price war. So I was looking at two industries which basically collapsed at the same point in time. I'm going to talk largely, though, about what we learned largely on the financial services side, which was very interesting. I think the first thing we learned is that there is no playbook in macroeconomic policy to tell you what to do when you voluntarily shut down an economy. That's really not one of the chapters in the macro textbook. And so we were throwing money at a problem before we actually thought through what the problem was. I think that is the general thing which we did with the stimulus package. What did we learn from all of that? We've learned, number one, that public health really matters. If you think about what happened during the COVID crisis, we told people to stay at home and stop spending, and they did. Now we're telling people that they can go out and spend, and they are. And so none of that is really a macro point of view, but it has huge macro implications. The second thing we learned is that circular flow really matters. All of you who are macroeconomists start learning about circular flow. What we did in the pandemic was we put a dam in front of people's spending. So I couldn't pay my rent, therefore my landlord couldn't pay his electricity bill, or he couldn't pay his collateralized bond obligations. The money was stuck. And therefore, the policy response, which was to give money to consumers, didn't solve the problem. Okay, so the third thing is the third lesson, I think, is if you are going to helicopter money down to people, you should remember that giving it to the infantry would be much more effective. Why my assistant, who continued to get paid throughout the entire pandemic, got now 2 stimulus checks, is just kind of a waste of money. Not surprisingly, what she and most people did with that money was they saved it or they paid down their debts. Those of you many of you have probably seen the work that the Peterson Institute did, where they estimated that 60% of the stimulus payments were saved or used to pay down debt. So only 30% of the stimulus payments actually went to people who spent the money. And we are still, I think, seeing the disbenefits of that as the economy tries to muddle through. Going forward, we're likely to see a huge boost to the economy as those people who have excess savings now spend them down. And we're seeing that in one of our credit card companies, where the balances which people are carrying are just lower than they used to carry. And so we are expecting at some point in time people to revert to their pre-pandemic spending levels, which will provide, I think, an unexpected boost to the economy in that regard. The overall summary of what I think we learned from that is that institutions matter in macro policy, and that most macro policy forgets that. The channels by which macro policy is supposed to be transmitted to the economy really matter. Take PPP, for example. 30% of the job losses we had last spring were in restaurant and entertainment. Enterprises which provided that employment only got 8% of the money. Why was that the case? Part of the case was we decided to distribute PPP through the banks. Well, the problem with that is most of the people who were affected were not big users, were not previous users of credit services from the banks. And if you didn't have a credit relationship with the bank, you couldn't get PPP from the banks. When we went to the government and said, why don't you bring the non-bank lenders into the process? They said, we don't know who the non-bank lenders are. There are too many of them. We can't deal with them. So some of the issues which Lisa was talking about are attributable to the fact that the mechanisms for the distribution of relief ignored those people that you wanted to get relief to in its entirety. Similarly, if you think about the recovery requires a very healthy non-bank financial a set of non-bank financial institutions, because those are the people who provide credit and services to the underbanked. They weren't helped. They were specifically not helped. I'll give you an example from the UK. In the UK, the UK decided that they were going to give mortgage relief to anybody who wanted. You didn't have to pay your mortgage. It's okay. You could call your lender up and say, I want forbearance. I want a 3-month holiday. That's terrific. But if you were a bank, that was fine, because the UK government would lend you money at 0% to finance that. But if you were a non-bank, you had to go find that money somewhere. And you know, you had borrowed all your money in the capital markets. The capital markets are not a place which you can go and say, I'm not paying, and they say, okay. So they, so in creating a solution to a problem, they then weakened the very institutions which would be needed to jumpstart the non-bank housing market for the lower income groups. It happened in both kinds. We saw it in the US. We have a company which lends into what I refer to as the you need it now, we'll lend it to you now business market. It's people who can't get bank credit. We saw about 15 or 20% of those people just go away. And if we wanted to provide credit to them, we had to borrow that money from somebody. And there was no appreciation that the non-bank financial institutions needed the same kind of support that the financial institutions did. So, you know, the lesson you come from that is that institutions matter. Second lesson is political actions have, as Lisa pointed out, they have implications that the policymakers don't realize. That the distributional implications of any policy need to be thought through in advance and not in reverse. I think would be the other big lesson to come from this. I mean, we spent, if you think about it, in the first quarter, we rolled out $3 trillion worth of relief and still had the economy collapse $2 trillion. That must have meant we were not doing something right with that money. And so I would say that the big lesson to come from this is if you're going to do these massive interventions, you should think through what the implications are in advance. And more importantly, should be more open to using non-traditional institutions to make that happen. The last point I would make really has to do with monetary policy in a different sense. Many of you may have followed what was going on in the capital markets. I'm sure Rahul was last October when they froze up. And they froze up at the overnight part of the market. It can't happen, right? This is one of those things which is not allowed to happen. There should be complete liquidity in there, but liquidity went away. The Fed stepped in and provided that liquidity. So what the Fed has effectively said to the world is, you no longer have to worry about there being a Minsky moment in the capital markets. If the capital markets seize up, we will stand by and take the run on the capital markets off the table. What that has done is it's caused the capital markets just to be even more risk on than they should ever be. I think what that poses a challenge for the Fed going forward is how are they ever going to tighten their policies going forward? Because every time they tighten, somebody goes bankrupt or whole sectors get hurt. And the Fed has basically said, we're not going to allow that to happen anymore. So I think the longer term question I would pose, which comes out of this, is how are we going to have effective monetary policy? If the monetary authorities are basically going to say, we're going to take the consequences of you over leveraging out of the system. I would worry about that for those of you who are professional economists, as opposed to those of us who are trying to retire. Okay, those are my introductory thoughts on this. Over to you, Rahul.
Thank you, Howard, and thanks again to all three of you. Encourage the audience to start pasting your questions into the chat box, and then as we kind of open it up to broader Q&A, Mary or I will unmute you, and you'll be able to answer your question to the panel. But please paste it in the chat. That's how we'll kind of keep track of the questions as they're flowing in. In the meantime, I'll get us started. I want to pick up on something that Howard touched on in his remarks about PPP. For those who aren't familiar, this is the Paycheck Protection Program, effectively a large-scale series of loans that were partially, actually majority forgivable, subject to certain conditions, primarily to small and medium-sized enterprises. And Howard touched on some of the distributional challenges of getting that PPP funding to the businesses that were in most need. One of the kind of broader debates that program was emblematic of is the nature of the U.S. labor market versus, say, our European counterparts. And in particular, historically, the U.S. in downturns has relied on forms of aid that are effectively not tied to a specific worker-firm relationship. I think, for instance, unemployment insurance is a canonical example of this. Whereas many European countries have historically relied on wage subsidies that intentionally preserve the link between a worker and a firm. But the PPP was a shift towards that kind of closer to wage subsidy-like model, even though it wasn't necessarily all the way there. I'd love to know what you all make of that. Is that sort of looking back at the trajectory of the past year, something that should be considered a success? And more broadly, how should we think about that in a world where we're maybe moving away from Howard's point about kind of needing to freeze the economy, and Jim, you had touched on this too, to having real reallocation that may need to take place as workers shift to firms that are better suited to, say, ongoing telework, types of goods and services that may be better represented or more represented in a kind of post-pandemic world. I'd love to hear your thoughts on that. Howard, why don't we start with you, and then we'll open it up to Jim and Lisa on that as well.
Thanks, Rahul. I'm not exactly sure which of the many issues you raised to talk about. I understand from the people who designed PPP that it was really an attempt to supplement the unemployment system. That people were concerned that the unemployment system would be too slow to be able to provide the kind of relief that was needed early on. And so the thought was, if you gave it to the employers and told them to keep their people around, it would take pressure off the unemployment system. I think it then got hijacked, as it were, by the social policy people that wanted to use it as a way to introduce a $15 minimum wage into the calculation. It was no surprise that $600 a month was about $15 an hour. And so the political overlay on the economic need, I think, is what caused the troubles in the PPP. What we see now is that supplemental insurance has become a problem for some low-wage workers. Right, there is a lot of evidence out there that for some small group of people that they decide they're going to stay on unemployment on the PPP and the supplemental insurance as long as they can, because it basically is better than going back to work. So I think it's back to the question of you have to look at PPP as what it was trying to accomplish, and if the goal was to just provide supplemental income to people, it was successful. If the goal was to provide an alternative to unemployment, it was successful. What it does in the long term, I think, yeah, it raises issues about, does it create expectations for minimum wages, which are going to be problematic for the economy?
Jim or Lisa, anything you want to add or raise on this topic?
I'd like to just jump in here. I think that the unemployment system proved to be very useful, and I think really supported the economy in a way that I think was just unimaginable before. The only problem is that not everyone, not all workers had equitable access to the unemployment system. It is still the case that a lot of African Americans are waiting for the unemployment checks to get to them. A lot of Americans still are. It would be useful before the next pandemic, before the next crisis, to update the unemployment system. You remember that California had to shut down its unemployment system for about 2 weeks, I believe, to combat fraud. And what we need to do, everybody knows this, we need to stop relying on systems that were built during the period of the hidden figures and trying to get, COBOL back and useful to update these systems. There really should be some investment in that. And the same is true for SBA. I was supporting using direct payments and getting them to people very quickly because SBA was going to be much slower than would be useful for the economy. This is, the pandemic was unfolding at breakneck speed. We needed something very quick. So that's why I supported direct payment and was hoping that these would be sped up as well. And Howard is exactly right about traditional institutions. I hope that before the next pandemic, before the next crisis, we also figure out digital payments. I think this is a very quick way to get everybody payments. And as we've learned from a new NBR working paper from, I think it's Fazio, Liu, Stern, and Guzman, that African Americans have created businesses at a rate that we haven't seen in the recent past. We saw something like this, especially among African American women during the Great Recession, starting small businesses, but this is really unprecedented. So I think that this was a way to get around some of those barriers that traditional financial institutions put up for African Americans in delivering this is also true for Latino communities, in delivering PPP. So I really think that this is something that should be invested in. SBA, it's not just technology. It is addressing these longstanding issues that make these relationships between Latino business owners, Black business owners, and traditional financial institutions fraught.
Rahul, let me just pick up here for a second, answer your question differently. As Rahul knows, I had recommended a different approach than PPP early on as a way to do this. I asked the question, what needs do people need to have taken care of? Yeah. And should the government, instead of giving people money, should the government just pay their bills for them? There really is no difference if you give me a check, if you pay my bill in some sense. But if you pay one of my bills, what you have done is you've reestablished circular flow. So I thought, for example, the government should consider paying everybody's utility bills for a couple of months. If you paid all the electric, gas, and telephone and cable bills for everybody for a month, it's $60 billion a month. You could have taken away the fear from people that they were going to lose their house, their heating, their electricity, or their communications with their grandmother for kind of like no money. And if you begin to think in terms of not providing, I know we like to provide resources to people so they can use them for themselves. That's good. We're economists. That all makes them better off. But in these circumstances where you're trying to solve basic needs, it might have been more efficient to deal with 1,000 utilities than to deal with 300 million people. So I think that if you are charged with being asked to think about how to get prepared for the next go around, you might think of alternative ways to provide the needs which people need satisfied, as opposed to merely supplementing their income.
Rahul, I'll just close off this conversation quickly. And, two things. First, we're going to be studying the effect of the PPP programs for a long time to try to tease out what their effects were. I think the early evidence suggests that they were not all that successful in preserving jobs. And the longer term question is, did they preserve businesses? And did they provide a lifeline to keep the businesses around? And what you want to avoid in a situation where you've got a very sharp decline that may then be short-lived is having this economic dislocation that flows from that short-lived period then leave you with long hardship going forward, right? So if you lose the businesses, it's a hard thing to get them reestablished and to restart. So I thought of the PPP in addition to getting around the sort of frailties of the UI system, which Lisa pointed to, and were very important, right? UI systems were swamped, so keeping people on the payrolls was really helpful for some of April and May of 2020. But providing a bridge for firms that will enable them to stay open, and keep in business when the economy recovers was an important goal. Now the downside to that is, maybe in the post-pandemic economy, we're going to have fewer restaurants around, and we're going to have less, some of these entertainment sectors are going to shrink. But of course, a PPP type structure ossifies the firms that were there at the beginning, and it gives them support. So it doesn't allow, linking back to Lisa's comments about the dynamism and innovation, right? You're not supporting the innovative side, you're supporting what was there at the beginning. So that's a fundamental trade-off. And I think we have to weigh that and try to learn from the experience in this last 15 months.
Yeah, completely agree.
Rahul, may I add just
ahead.
one tiny thing to what Jim just said. One of the biggest concerns that I articulated when I was testifying before Congress once a week during July last year, and one of the things that I raised was that innovation often comes through new firms. And Jim's pointing out that PPP preserved the old firms. I think this is huge because innovation is something we count on for long run growth. And if the smallest firms who don't yet have a relationship with a traditional financial institution are the ones that were at biggest risk of failing, of not even getting started, I think this is going to be one of the legacies of the PPP, that it really locked out early on those that are potentially the most innovative firms, the newest firms.
Thank you, Lisa. So we've had a couple questions come in on the chat. I want to give Ian O'Grady, Ian, if you're still on, a chance to raise your question to the panel.
Yeah, thanks for the opportunity. This has been a really great panel. I primarily work in local policy, and so I'm really curious to see what the panel thinks on private capital, because there are mountains of private capital on the sideline that are looking to be deployed, and we're starting to see it. Blackstone just had a huge purchase of multifamily developments in San Diego. As someone who's concerned about local ownership of commercial real estate, housing, I think that those can benefit both small businesses and families in affordable housing. How do you see that private capital being deployed in those cities? It seems like a real risk to who owns our cities and who is served by our cities.
So open to any of you on the panel.
I think Howard should start.
Okay, go ahead. Sorry, Jim.
No, I think Howard should start on this one.
Yeah, well, because I represent that new thing known as private equity, it's okay. Yeah, there's a lot of private equity capital around. Most of it's not available for the kind of things which Lisa's talking about. Most private equity is designed to deal with mature businesses. The venture side of the business, which I'm in, is a much smaller part of it and doesn't address the issues you've talked about. I think would be the short answer to the question. I would think that the solution is more along the lines Lisa's talking about, is making sure that the institutions who provide the services that you need are well funded. And whether they're, whether they are publicly owned or privately owned, I don't think is much of an issue. I don't know if that addresses your question directly, but I don't see that the war chests of private equity being they're opportunistic, but they're not builders, they're buyers. It's kind of my reaction. You know, but I know that the institutions, I can speak from some of the companies we finance, the institutions which are designed to provide capital to new businesses are healthy. In that sense, capital is flowing to the extent that it needs to flow to institutions, to businesses which need to get restarted. And the government rescue packages were specifically not designed to help start businesses. If you looked at the Main Street Lending, for example, program, that was only for businesses which otherwise had capital. PPP did not provide working capital, which is what you need to restart a restaurant. My observation, though, is that entrepreneurs are smart. And I went to, it was funny, the first restaurant I went to after we came back to the city after 14 months turned out to be the same restaurant that was the last restaurant we went to on March 9th, 2000. The same people, but a different name and a different owner. Because the guy who owned it just said, I can't pay my rent, forget it. They shut down for a month or two, and then the staff got together and went to the landlord and said, we'll restart it, but we can't pay the rent. So there was a little self-help which took place there. That's an anecdote, not a statistic.
We had another question come in from Prabal Chakrabarti about, I think, touching directly on some of the heterogeneity dynamics that Lisa, you and Jim had pointed out. Prabal, if you're on, would love to hear your question, address that to the panel. Prabal, I think you're muted.
I think the question is as it is in the chat. I think the flavor on it, I guess I'd say, is what about this post-pandemic? Like, a lot has changed. What are the new opportunities to reduce some of those longstanding disparities in unemployment? I'd love to hear views on that. I do work at the Fed, but I'm speaking for myself today.
I'll just jump in quickly here. Some of the proposals that I have put forward with respect to getting more women and underrepresented minorities into the innovation economy are relevant here. A lot of them have to do with the care economy. Many women can't participate on patent teams because sometimes patent teams like to work at odd hours, if we're thinking about the Google model, and they like to play soccer in between and have Cheerios on hand 24 hours a day. And women often have to go home and take care of families. We know this from the American Time Use Survey. So if childcare is addressed more systematically, I think that more women could participate, not just on patent teams, but in other jobs. And that's one thing that is holding people back from getting back to work now. It's that childcare is not available. And I think this is one of the most robust conversations we've ever had about the care economy. And I hope that it will be paid attention to going forward.
And Prabal, the other thing I would just say is, one of the things we've clearly learned, or really we should have known, but we've had shown to us more vividly during the pandemic, is the fragility of the labor market at the bottom, right? The nature of the jobs that people are working in, the low wages and the challenging conditions that they face. And the traditional response to that is to say, well, let's get better education, let's get skills. And that, unfortunately, as your comment in the chat suggests, what's going to work in the immediate term. In many cases, those are not fast solutions, right? They are slower paths to try to address this. I think it's important not to lose sight of those traditional remedies in some sense, and to think that we should be focused and whether that's everything from high school completion programs to community colleges to encouraging employers to provide on-the-job training. All of those are places where we can potentially try to intervene and try to help and support those folks at the bottom, in addition to the things that Lisa just talked about.
An interesting perspective on Lisa's question is you solve the problem at the bottom of, if you view most low-wage jobs as entry-level jobs, you solve a lot of that part of the problem by making sure that the the employment above the low wage jobs is very healthy. So you suck people out of those low wage jobs into better paying jobs. And so a lot of focus should be on making sure that the one and two steps above the bottom are also very healthy, because it's the need to provide those jobs which provides the support at the bottom of the economy. You know, and so making sure that you've got the institutions to create the upward mobility from the entry level to the next level, to have the right skill sets and the right opportunity sets there, I think it's pretty important.
So we have a couple more minutes. Maybe just one question to kind of cap things off.
Trickle up.
Following, sorry, say again, Howard?
I said that's trickle up.
Trickle up. That's right. One of the big developments following the 2008-2009 crisis was a kind of rethinking of how to integrate conventional macroeconomic models and forecasts, and even just heuristics with how to think about financial markets and financial fragility. That was a big focus in the academic research community, as Jim can no doubt attest to, overseeing the NBER, but also in the markets from private sector analysts and government agencies as well. Would love to hear some quick thoughts from the panel about in what ways you all think how the world thinks about macroeconomic forecasting will change as a result of this particular shock, whether that's taking into account some of the heterogeneous features we were talking about, or other factors. Kind of open that up to any of you who want to comment.
I certainly.
Okay, who's the first?
I was just going to say, I think these heterogeneous factors are ones that we really need to take more seriously. As you probably know, many of our macro models seriously focused on a representative agent for a long time and did not have the kind of heterogeneity we need to focus on now. Of course, that has changed, but sometimes when models are deeply embedded for generations of macroeconomists, it's hard to depart from them, even if new research exists. So I think the heterogeneity is one thing. I also think, like I was saying about potential output, that we need to think about the structural factors that affect potential output and find ways to bring people into the economy, into the innovation economy and all sectors of the economy that we might have ignored in the past, or that we might not have been aware of in the past. So I think there's a lot to do on our macro models generally.
Okay, great.
I think one of the big takeaways, Rahul, is that fiscal policy is more of a tool for stabilization than we have thought about, right? If you went back, 15 years, people basically said monetary policy is what handles economic fluctuations, and fiscal policy is too slow. It's going to come on at the wrong time. It's just not timely and targeted. And I think what we have seen in the last year is that, in fact, we can use fiscal policy quickly. It can be used to distribute. What I think we have not spent enough time thinking about is how do you fine tune fiscal policy. And to comment on some of the things that Howard said, right? I think we can forgive many errors in the design of policy in March and early April of 2020, because we were in an unprecedented situation. The economy was in free fall, and we just needed to do some things to try to help support the economy. But after that, we had time to think about what we were trying to do and trying to target the resources to places where there was real pain is something that should have gotten more attention. And in fact, what we saw were continued relatively blunt instruments as we went forward. And that's something I think we should be trying to focus more attention on as we go forward, how to target and how to design better policies.
Perfect. Well, thank you so much, all three of you, for taking the time. Thanks again to Mary and Nell and the MAC and the AMS respectively, and appreciate the audience for the great questions and the engagement. Thanks, everybody.
Oh, thank you very much. Thank you, everybody, for that. It was absolutely fantastic. And we will be putting this up on our website. So those people who have missed it will be able to watch it. So thank you so much.